investor is really starting to think about what is this endeavor that you're going into, this investing part. And I believe one of the best things you can do is you invest in yourself. Take the time to learn, read, go on YouTube, try to find credible sources and learn everything about it. You know, how markets function, how to buy stocks, what does it entail, what does it mean? Look into the history of markets. You know, what have they done? What have different periods been like? Read about investors, different strategies, successful people, unsuccessful people, maybe more important, business people. All of these things help us. They help us understand the world that we're investing in, the world around us. I know it sounds a little bit trivial or maybe a little bit boring because people want answers really quickly, but I think this is one of the most important parts of being an investor, is being curious, asking questions, trying to find answers, and sort of putting it all together so that you have a clear view of where the world is, an understanding of where it might go, and then you can help yourself understand this so that you can make better decisions going forward. So based on that really quickly, I thought if you take away anything from this, I would say this screen, maybe jot it down, take a screenshot. And really what it is a couple of good books or reading sources. And I'm going to implore everyone to take a look at that very first line, A Wealth of Common Sense. The author is Ben Carlson. He's a US-based author. And I think for anyone starting in the market, this book might be the best tool to begin. I have a copy. I read this every year. I've read it now, I think 5 or 6 years running. It's that good. It just reminds us of all the basics that we need to have to think about markets from an investment standpoint, from a behavioral standpoint, from a strategy standpoint. Now, some of these others in here, you might recognize some names. Berkshire Hathaway, that's the conglomerate that Warren Buffett built. It is a wonderful case study on investing and business management. And then we have a variety of other books. Some are a little easier to read, some are a little harder, but take a look at this list, grab a couple of titles. And if you're interested in this is a great place to start. We'll touch on some of this more in Q&A, so I'm going to gloss over it. But let's get to the basics of investing now. So when we invest, I think we need to understand sort of the context around just simply how do you go and buy or sell something? Where does that occur? So the first thing I would have us think about is exchanges. You know, what is an exchange? Essentially, it's a digital platform. Here in Canada, the major one is the Toronto Stock Exchange, but there are smaller ones, such as the Montreal Stock Exchange. And on these exchanges, we're effectively bringing together all of the participants of markets, and they're putting in buying and selling orders on various stocks or ETFs. And it's where we come about having prices. This is how we find what the market is going to price a stock. And the two most common assets you're going to find on exchanges, one is stocks, individual stocks, companies like TD Bank or Amazon or Google or Apple, but also something called an exchange traded share or ETF, which is just a different way to invest in a basket of stocks. And we can cover that off a little bit more during the Q&A. So let's get into what is a stock. You know, I bet some of us or some of the listeners have paid attention to maybe BNN online or on television, or you go to Market Watch or CNBC and you see these tickers, these numbers flashing up or down, big headlines, breaking news, Dow in turmoil, et cetera, et cetera. You know, all of this is really noise because at the heart of it, really what a stock is you own a little part of a company. And that's something I would have you guys always remember. It's not a price that moves up and down. You own a part of a business. And the value of that business really at the heart of it is it's derived from profits and cash flows. So company A sells a widget costs $5 to make. We sell it for 10. We have a profit margin of 5. And if we own this business and we can grow that over time, that business will be worth more because it's generating profits. It's growing its value. Now, a price of a stock is a little bit different than the value. They're tied together in that the price will influence or have an influence on the value or vice versa. But the price of a stock is really just driven by supply and demand. It's people want to buy it, people want to sell it. If you have more buyers than sellers, you're going to see the price go up. If you have more sellers than buyers, you're going to see the price go down. And so at any given time, that price is just the market's estimate of what is this company worth. Now, I know that this sounds sort of simplistic, but this is in the short term. Over long periods of time, I go back to my comment that the stock's price and value, they're going to likely converge, and it's really going to be influenced just about profits and about growth and sales for this company. I say this over, but this is probably the most important thing, especially when we look at companies when we're thinking about investing. I often tell my clients or any investor when they have a question about a stock, says, should I buy it? And I'll ask, well, why do you want to buy it? What's great about this company? Are their sales going up? Do they have nice profit margins? Do they have something coming up that's going to really drive demand higher? These are just fundamental questions rather than looking at, well, the stock price is A and I think it'll be B or it should be B. That becomes more just a speculative endeavor. But by learning about the business and understanding how prices come about, what drives them, I think we become better investors. So always remember, a stock is a partial share of ownership for a company. And the duty of an investor is understanding, what am I getting for it? What amount of profits, what amount of sales growth, et cetera. So this I touched on this point a little, but I think this is important to drive home. Like, what makes a successful investor? Like, what makes a stock we buy better than the next one? And this is a tough question to answer. There's a lot of things that converge and that influence a stock price. In the short term, really, it's just sentiment. You look at people's perception of what the future will look like, and that'll drive a stock. We've probably, I don't know if anyone in the audience has heard of a company called Nortel. Now let's go back 20 years ago. Nortel was the darling stock in Canada, but it was also globally. This was a behemoth during what we call the dot-com bubble. And Nortel at one point was worth something like 1/5 of the entire Toronto Stock Exchange. This company seemingly could do no wrong. And people would just buy it and buy it and buy it because, it just went up and up and up. But underneath the surface, for an investor that looked at what was going on with the business, they would find that actually Nortel was struggling a little. And arguably there may have been things like fraud going on underneath the surface, but the company eventually went bankrupt. It went from darling to bankrupt. And there's a lot of different factors that come into play for a company like Nortel or a stock like Nortel. And there's many different examples of it. But I think the key thing is when we invest, we always have to ask ourselves, what is the business strategy here? What are the competitive dynamics? What are the financials? What do they look like? And what am I actually buying here? What is my hard-earned money going to purchase? What is the value? And so you don't need a degree in accounting to know that. I think you just need to have a basic understanding of some of these concepts, financial and economic. And if I can leave you with one thing is think like a business owner. This is so important because, again, what do we do when we buy a stock? We own a fractional share of a company. So this is the kind of stuff I want the listeners to think about because this is what professional and some of the most successful investors have done throughout their careers, is thinking like a business owner, buying companies and holding on to them for fairly long periods of time. So that talks a bit more conceptual stuff, like what is a stock, where does it trade, et cetera. Now, I think it's important to just also think about how do we buy and sell stocks? Because some of you might be brand new to this. You might be seeing some headlines on Twitter, could be on Instagram, could be via Google on the news. I don't know where, but you're probably seeing things like, Tesla up 800% this year, or markets at new highs, or markets at new lows, markets crashing. You're seeing headlines in the media. You're being inundated with bits of information. You're thinking to yourself, well, I want to get into this. I want to try. So, once you've spent some time learning a little bit about markets, you also need to learn how do I actually go in and do it. And so this is going to be basic, but I think it's important for us to touch on it. And that is the first step. Let's say you want to buy a company. Well, you're going to need to figure out something we call the symbol or the ticker. So I use an example with Amazon. We all know Amazon. We probably all love Amazon. Well, Amazon's stock symbol is AMZN. And so if you want to buy it, you're going to go into your online brokerage account. You're going to type in AMZN as the ticker, and that's going to pull up Amazon stock to buy or sell. Now, the next step from that, we got to figure out how many shares to buy. So I think it's an interesting time to bring up a point that I see all the time, and it may be important to some, may not be important to others, but I want to note that the price of a share, absence of any other information, so Amazon trades at $3,100 approximately USD. The price of a share tells you nothing about what you're getting, aside from just what it costs to buy that one share. What matters in relation to that price is the fundamentals or the financials of the company. What level of profits, how many shares are out there? So what's the value of this company? These are ways, this context, this information helps us understand what does it mean to buy a share for price A, B, or C. And that's important to note. Now, I'm not going to go any further in that, but just note, buying a cheaper dollar value share, so a share that costs $1 relative to one that costs $3,000, it's not a better buy. That's just the price that that one share carries. Absence any other information, that's not telling us anything. So anyways, let's go back to it. How many shares would you want to buy? So let's say you have $5,000 to invest and Amazon costs $3,000 a share. Well, that math is simple. You can buy one share. We can't buy a fractional share or half, not just yet. Actually, that's probably going to come out at some point in the next, let's call it 5 years or so. But the key here is we just got to take the amount of money that we want to invest, divide it by the price of the shares, and that's how many shares we're going to want to buy. So when you're going online, you're going to type in the symbol, then you're going to input the amount of shares you want to buy. The next thing you're going to need to do, or want to check, I should say, is something called the bid-ask price. So what does this mean? The bid price is what investors that are offering to buy the stock, what are they offering? You know, for Amazon, maybe they're offering, they want to buy at $3,110. But the other side of that is sellers. And sellers, or their offering to sell, is shown by the ask price. And that is the seller saying, well, this is what I want in exchange for my shares. So they might say, you know what, for Amazon, I want $3,120. What will happen is the market is going to go between the bid and the ask, and we're going to probably find somewhere in between. Buyer and seller will meet, and then that will be dictating the price. Why I bring this up, depending on the type of shares you buy, pay attention to how big the difference between the bid and the ask is. If you're buying really small companies, let's say stocks that are worth pennies, maybe even a couple bucks, and not a lot of shares trade, you can have a very wide difference between what people are willing to buy and people wanting to sell. And that's going to influence the type of order you're going to place. Because let's say you go and you say, well, the bid might be $3,100, the ask might be $3,100. I'm just going to place an order, what I call a market order. So I'm going to take what the market gives me. And if the bid and the ask are really close, you're going to get more or less the price you see on the screen. But what happens if you have a big difference between these two, the bid and the ask? Then I'm going to urge everyone listening, use what we call a limit order. So what that means is you're going to specify to the broker at what price do you want to buy those shares. If the price is above that, they're not going to buy the shares. If it's below, you're going to trigger a purchase. But the reason it's important, especially when we're going into stocks that don't trade very much or very small stocks, is by putting a limit, you're not going to get a surprise that your order gets filled at some ridiculous price way above or way below the buy or sell. We see this happen in our world once in a while. Mistakes are made. It often becomes very costly. But the simple thing I tell all investors, always use a limit order. You can base it on the bid and the ask, but by using the limit order, you're protecting yourself from filling at prices which were not what you had intended. And in some cases, that can mean a material amount of money more or less than was anticipated. And this last comment is ridiculous, but believe me, I've made this mistake myself. Review all the details before you press submit. Review the stock you're buying, whether it's in Canadian or US dollars, how many shares, the bid, the ask, if you're going to use a limit or a market order, and then press submit. Can't tell you how many times I tried to rush something, press submit, ooh, mistake was made. Mistakes cost money. They tend to be educational. You pay for that education. So just be mindful of that. All right, so that was a bit of the mechanics of investing. I know I glossed over it, but I think for many people, that's fairly basic information. You've probably covered it in some regard, and it's readily available online. So I didn't want to spend too much time. We could certainly go back to that during Q&A. But now I want to get to more of the meat of the presentation today. And what I call this part is really stock investing, the numbers behind returns and risk. And this is the fun part of investing in my mind. Understanding the sort of world within which we invest. So, you know, at this point in time, I often will say, all right, if we're investing, we probably have a reason to invest. Something is driving us to do so. And oftentimes it's trying to obtain some sort of profit or income. You know, the definitions vary widely, but really what I would suggest is that investing is the act of laying out money now with the reasonable expectation you're going to get more in the future. That's a very, very sort of straightforward, very objective type of definition, but I think there's more to that. And I would say that another angle is that investing is really foregoing consumption now with the hope or the expectation, I'll use expectation better than hope, that you're going to get more purchasing power in the future. And I'm going to relate to this in just a moment with some numbers, but I think this is a really neat concept, is always think a dollar saved is like a dollar earned in investing. Because once you save that dollar and you don't spend it now, if you invest it, it's not that that dollar is only worth a dollar. In the future, in 10 years or 20 or 30, it can be worth multiples more. That idea of compounding is so important. And that's really what we're after, having more purchasing power in the future. So let's get into the numbers a little. Why is the market good at sort of creating wealth? Well, if you sort of look at major markets around the world, whether that's in Canada, the US, or international markets, they have on average generated returns, and these are called nominal returns. So this is including inflation, but those average annual returns have ranged somewhere between 8 and 10%. The exact figure will vary depending on where in the world we're looking at, the time horizon we're looking at, but it generally falls in this. And interestingly, most of those averages do converge around a sort of similar type of return. Now, what does that actually mean? So a little bit of context here. Let's say you grow at 7% a year for 30 years. So I would imagine a lot of the people that are here with us today are relatively young, some older, some younger for sure. But my guess is a fair amount of you have a long time horizon in terms of that from investing now to the point where you need the money. So if we think about this, you earn a 7% rate of return over 30 years. Every $100 that's invested at that 7% average annualized return turns into about $800 in 30 years. So $100 30 years later is worth $800. Now, if the rate of return jumps up to 8, so from 7 to 8, the same $100 after 30 years is worth about $1,000. And let's take it a step further. Let's go to the high end of the estimate here. So let's say we grow by 9.5%. It's an arbitrary number, but I chose it because of the output. But your $100 over 30 years at 9.5% average annualized turns into $1,500. So you take a moment, you think about that, that's incredible. $100 to turn into $1,000. You don't need to really do much. You sit there and allow markets to do their thing, and your money is worth more. Now, let me tell you that's really simplistic, because average annual returns can be really misleading. Actually, when you see on a year-to-year basis, we rarely get returns around 8 to 10%. Probably only about 10 to maybe 15% of the time. Most of the time, it's way above or way below, and then they average out. Now, the important thing with that is the returns, because they're not sort of averaged in a linear fashion, 8 to 10, 8 to 10, 8 to 10, they can be much higher, much lower. It's important to think about how those returns come about. And this is an amazing stat. I'm going to show you guys a chart on a couple of these things in a moment, but if you're investing long-term and you miss even a few of the best days, months, or years, you can dramatically impact your returns to the negative. And we'll have a chart that we're going to get into in a moment to illustrate that. But really, one of the takeaways you're going to see is that historically, markets are rising or advancing more than they decline. And the best returns that we see when you look at all the different investing strategies and the different investors is literally just stay in the market, be invested for long periods of time. Don't try to time when to be in and when to be out. So when I'm talking about this long-term return, I thought this was a great little graph to show everyone. You've probably seen versions of this. And this is a little bit misleading because it's showing us a time horizon from 1926 through to 2018. And it is based on US data, mainly because US markets have been around a long time. The key takeaway here, you'll sort of see that US large cap indexes, which is just the biggest companies in the US. If you had $1 in 1926, it was worth close to $7,000 by 2018. Now, here's the caveat. No one lives, well, few people will live or be invested from 1926, 100 years on. But the key information in my mind is just looking at these trends here. So when we look at investing in stocks, I think you could tell right away that line upwards is really jagged, and there are some really terrible periods in there. But by simply being invested over long periods of time, markets are unequivocal in their ability to provide very strong returns on our investments, on our capital, so long as we don't make mistakes. So this next part sort of talks about why the average annual return I talk about, 8 to 10%, is a bit misleading. And what you're seeing here is what we call a distribution of the US market's returns. We're using, I believe in this case, it was taking information that was from the Dow Jones and the S&P 500. They merge them so that we can get an idea of this time series. And what you're going to find is all the blue boxes are periods where markets were positive. And at the very bottom index, you're going to see the range of those from 0 to 10, 10 to 20% returns, 20 to 30, so on and so forth. Now in the red, you're going to see the negative years. The first takeaway here, and it actually touches on this when we look at the positive years, negative years. Markets, on average, any given year, are up about 3/4 of the time and down about 1/4 of the time. And again, going back to time in the market, that relationship, the fact that it's rising more than falling, is a reason why being patient and just sticking with your investment strategy, sticking with the markets despite the ups and downs, is a good idea. And now this is a little bit, we're going off a little bit, but I think one thing that I use often when I'm talking with my clients, we see periods where markets fall 10% fairly often throughout the year. And you'll see that column right here, these 0 to 10. So let's say we're in a period where the markets have fallen 0 to 10%. It's not fun. Let's say at $1 million to start, now it's worth $900,000. So the natural inclination there is probably to panic a little bit, question yourself, maybe get out of the markets. Markets might fall more. I don't want to be part of that. But if I were a betting man and I were to use probabilities and I would look at, okay, we're here right now, and the outcome for the rest of the year could fall somewhere between these blue boxes here, or the 5 instances where things got worse on the other side, and this does not have 2020 or that period we saw. I think the bet should always be invest on markets going higher. Doesn't mean they always will, but from a betting perspective, from a probability perspective, bet on markets moving higher. So this last part here just illustrates the importance of a couple of things in my mind, but one is this time in the market. So what you're seeing here is from 1956 through till about 2017, any blue area, so you see these blue increases, are periods where the market's advanced. It shows us the amount of time and the percentage increase. The red ones are the corresponding declines. Now, let me give you a bit of information on this. The first one, the movements up and down are totally random. It might look like there's some patterns in there. There are none. This is completely looking backwards and using our hindsight bias. When we're living through that, we never know what tomorrow will have in store. But you should take away, and this is building off the last slide, markets gain much more they fall. Periods where they fall, you're probably going to notice they don't last as long. They tend to be sharp, very, very deep. There's a couple outliers, like around the 2000 period. But as an investor, you always have to remember that. The good times will not last forever. The bad times will not last forever. The bias should be towards growth, but we should always be prepared for this concept of risk. So we're going to now shift over a little bit. We're going to talk a little bit about risk here. And if I could, I think the thing that I'll note here is risk is different to everyone. What I like to say with risk is risk means that more things can happen than will happen. This is applicable to everything in life. It's not just investing, but we need to think about risk in investing, because really, why do you get better returns from investing in companies than you would just holding your cash? Well, the reason is you're risking your money, and that virtue of risking your money, you should be compensated with better returns. But I think we need to be mindful of something. It also means you can lose your money. The risk is very real. It's not that you're going to be guaranteed that extra return for taking more risk. You have the possibility of getting it, but you also have a higher possibility of losing your money or seeing a negative return. In terms of talking about risk, it's very multifaceted. The one thing I would say for everyone on this call, this first bullet called systemic risk, that's when markets fall as a whole. That's what we saw in early 2020, February, March, to a degree in April. Let me tell you something that you need to get used to really quick. You can't avoid it. This is, I would argue, the risk all investors have to accept. And in accepting it, I think this is the easiest risk to deal with. As long as you're not investing with leverage or investing beyond your means, so using money you might need to live, you can wait out systemic risk, because it's not one thing really that's causing acute pain in the market. It's the market as a whole is going through an adjustment. And it might be scary, but note, as I showed you before, It always comes to an end. And the good thing is during those periods, they tend to be wonderful times to buy. So take systemic risk for what it is. It's uncomfortable. No one likes to watch their portfolio fall by 30% or more, but it will pass. As long as you are properly diversified, that will pass. Now, that diversification comment, I think that's important because when you're buying stocks, you're taking a kind of risk that's very specific to that stock you buy. It's called business risk. What if the business fails? Now, interestingly, just talking about this for a moment, throughout all of the history of markets, it's estimated that between 4 and 7% of all stocks in existence provided all of the excess returns compared to owning more or less cash. What does that mean? It means most stocks actually don't make money for investors. Most of them do fail. A small subset survive, and they go on to provide a lot of the returns for the market as a whole. But note that most companies you look like probably won't provide that great of returns, and many of them are going to fail. So pay attention to business risk. The way you can work around that is diversify. One of my favorite investing tools is the use of index funds. You can look at Vanguard or iShares. These things literally buy the whole market. You don't have to think about it. You just simply put your money in month over month, year over year, and the market is going to move as all the other participants go in and out of it. And you're just going to benefit from all of their decisions. And one thing it does is it removes business risk, more or less. It diversifies it away. So just note that when you're buying stocks, always remember most businesses are not going to be the next Amazon. Very few are. Most businesses, I think the majority of businesses are going to provide returns which are probably subpar. It's hard to know which ones will do that in advance. So always be humble when it comes to buying them. The last one is that I think I wanted to bring up is liquidity risk. What does that mean? Well, simply, you might not be able to sell the asset that you hold quickly at a reasonable price. So this is interesting, I think, in terms of this GameStop and many of these what we call meme stocks with the Reddit phenomenon. You know, in many ways, I knew what the ending was with GameStop. A lot of people did. It was that eventually the price was going to crater. It doesn't take a rocket scientist. Even the people taking part, especially the big hedge funds, they knew that this was going to be the outcome here. The problem is once you squeeze out all the shorts, as was well telegraphed, everyone's holding, let's say, GameStop shares at big valuations. But when everyone wants to leave and the valuation is not based on the company's prospects, all of a sudden everyone rushes to the door. There's no liquidity. No one's there to buy the stock on the way out. Prices can crater. And that's why I went from $500 approximately at its high to I think about $45 now. So just be mindful of that when you're investing in perhaps more speculative types of investments. Now, that might scare all of you, right? That doesn't sound fun. But you know what? There's a risk with not doing anything in your money, and that's called inflation and losing purchasing power. And I'll tell you now, everything gets more expensive through time. If you look at your grocery bills, your Rogers or Bell bills, whatever they are, your internet bills, clothes, cars, homes, everything is getting more expensive. Sitting with large amounts of cash, not doing anything for you, that hurts. It doesn't hurt in the short term because you'll feel good, right? You're gonna have this pile of money. But long term, that money might be worth 10, 15, 20, 30% less in terms of what it can buy. I think that's a bigger risk than one every 10 years seeing your investments fall by 20 or 30%, but growing on average by 8 or somewhere between, let's say, 8 and 10. So, you know, let's put that in summation. Always be aware of the risks that are tied to your decisions and aim to minimize their impacts. You know, I often tell a joke in finance, not really all that funny, but what's the difference between an 80% loss and a 90% loss? Well, the difference is that the 90% loss was down 80% before it went on to lose another 50%. Probably not that funny. The key takeaway here is risk is real. You can lose all your capital very easily. I haven't even touched on the most risky parts of the market or some of the most, what I call exotic ways to invest. But the key takeaway is the market doesn't owe you anything. The market is a vicious place to learn lessons. You are competing against very smart individuals with lots of resources. Actually, most of them are now computers, and they all want to take your money. They want to profit. In investing, it's what we call a zero-sum game. You can only, the gains and losses, they have to offset each other in a one-year period. So note that really most people are not going to win by trying to choose when to buy, when to sell, or taking big risks, not taking big risks. So just always remember these types of basic pieces of information when you go into investing or think about investing. Note that you can lose your money. And while there is great upside, if we don't pay attention to risk, we can lose that all in a hurry. So that probably covers a lot in a fairly short period of time. What do we do? 1035. All right. So I think that's probably enough of my lecturing about all these different types of concepts. I think we'd be well advised to maybe start Q&A. We can jump into this. We can have some great discussion. And if there's anything that we need to rehash, I could definitely jump into it as we go through the Q&A.
Awesome. Thank you so much, Ivan. I'm just going to stop your screen share here. So thank you for sharing your insight into investing into the stock market with our attendees today. We now like to invite any questions from attendees via the Q&A box along the bottom of the toolbar. Just a reminder that we will not be answering questions that are related directly to what stocks to invest in or how much money to invest. So we already have a question to start us off, and it is, what kind of tools should we use? Is Wealth simple or something like that beneficial to look into?
Yeah, this is a great question from the anonymous attendee. So, we're living through a great time to be an investor. The options available to us have never been greater. The cost of investing has never been lower. Access to information is readily available. So yes, I would say that there are some tools to use, and Wealthsimple is a wonderful one. Many of the big banks, as well as different brokerages and Wealthsimple, all offer very similar types of investment platforms. But I will say I like Wealthsimple because the ease of use, very straightforward in terms of the user experience, I should say. And the key takeaway here is, I think when you're following what Wealthsimple does, and there are others, for most investors with these platforms, you're investing in index portfolios. They're very low cost, they're very efficient, and you're going to be better off than most investors using these types of tools. So all I would say is, yes, Wealthsimple is a great option, but so is any brokerage that you can use on your own. The key takeaway is keep your costs low, stay very diversified. Now, if you want to do more stock research, I would point you towards this website called Koyfin Charts, Koyfin. And you can Google that. It's a great resource to learn more about individual companies.
Great. And there's another question here, very similar, wondering about Questrade.
Yeah, I group them all about the same. I love, I should say, it's funny, I love Questrade's marketing, the 30% better. And so they're doing a great job of getting people to question the way things have been done forever. The truth is, it's very marketing gimmicky. There's a lot of data that comes out that shows, their investments and their proprietary ones, which they're really not better than what you're getting at Wealthsimple or anywhere else. But yes, I would say Questrade is lumped into the same type of scenario where they're low cost. They give you options to get exposure to all the different types of investments you may need. More important than anything, though, is what you're doing with it. So buying low cost index funds, the best possible option. I like Wealthsimple. I like Questrade for those things. So yeah, I think that's just as good of an option. Absolutely.
And on a similar note, an attendee's wondering, are these apps that you use to track markets and companies and individual stocks?
So you can use them through those platforms. Going back to this website, Koyfin Charts, Koyfin, you can Google that. I'm going to say that's probably the best resource for tracking companies as well as getting their fundamental or technical information. So I would probably have them sooner use that third-party application for these purposes, the tracking and learning part, and then use Wealthsimple, Questrade, or any of the big bank discount brokerages for the execution of your investments.
Great, thank you so much. The next question is a little bit generic, but the attendee is wondering, as a brand new investor after listening to this talk, what is the first step to do to proceed with wanting to invest?
Love it. So, I would say the first step, you got to open up an account. Now, I would go back to learn a little bit about this, right? Read some books, go whether it's Twitter, YouTube, and just learn the basics. So The Wealth of Common Sense by Ben Carlson is my Bible for that, is just to get started. But the key thing for a brand new investor, stay away from individual stocks to start. I think there's nothing wrong with it, but I think you're taking more risk than you need to. I would stick with an index fund. So you can look at things like iShares or Vanguard. They have index portfolios. It's one stock which owns an entire portfolio. It's very, very cheap. All you have to do is on a monthly basis or every couple months, put your savings into it and forget about it. You don't need to give it any attention. Arguably, you're going to do better than most investors with that, but I think that's the best way to start.
Great, thank you. The The next question is, what is this? And sorry, this is a monetary one. So if we want to skip by it, that's completely okay. But they're wondering, what is a safe amount to start with when initially entering the stock market?
Okay, so I mean, there's no right or wrong answer. Smaller amounts, I would say, stick with index positions. So Vanguard, iShares, I mean, any of the big major, what we call passive investment providers are your best bet. I tend to like Vanguard. I like iShares as well. The reason is you want to diversify. Now, what's a safe start to amount with? I would say that really whatever you have the ability to withstand a loss with. So not to say you're going to lose it all, but don't invest money you need in a year, right? Because markets could be down about a quarter of the time. So only invest what you know you can set aside for longer periods of time. And in terms of safe amount, it depends on your circumstances. So for a millionaire, it'll look a lot different than someone that has $10,000 saved to their name. You just have to find what you can live with not spending for a long period of time. That's the safe amount to start investing with.
Great, thank you. An attendee is wondering how a TFSA, so a tax-free savings account versus a normal savings account. Is there a difference? Is there better to be investing with one account over the other?
Yeah. Tax-free savings accounts are incredible. So, the key takeaway there is you never pay tax on any money that is grown in these tax-free savings accounts. You also have the ability to take money out and recontribute it at a later date, subject to waiting till the next calendar year. So in terms of, why we don't have to pay tax on TFSA, it's just an incentive by the government to have people saving more, to invest, to take care of their own financial futures. What I would say, though, with the tax-free savings account is if you're going to get really, really speculative or take some big risks, you got to weigh the fact that if you lose money in a TFSA, you do not get any benefit from a tax perspective. So in a regular investment account, if you lose money, it's what we call a capital loss, and that can offset future capital gains. The TFSA, because we don't pay tax on gains, we don't get the benefit of losses. But further to that is, it would be tempting to take big risk in the TFSA because if it goes up tenfold, it's all tax-free. Always invert it though and say, what if I lose it all? So if I have, $100,000 of contribution room, I put $100,000 into a stock and it goes to zero, you just lost $100,000 of tax-free sheltered room to invest for your future. The opportunity cost is huge. So I tend to say very, very speculative investments. A little in the TFSA is one thing, but if you're going big, use a regular investment account. Be mindful that this long-term compounding tax-free is very powerful. So you think about my comment about $100 turning into $1,500. If you average about 9.5% a year, or 100 turning to $800, that style of investing works well in a TFSA. Slow, boring, but very efficient.
Great, thank you. An attendee is wondering, if they invest in one company, how often do they need to research that company's status?
So it depends on your comfort. If you're me, you're going to be researching every quarter as to what's going on with the company. You should know it like the back of your hand. You should honestly think of it as if you are one of the principal owners of that company. The reason is you got to make sure that you know what you're investing in. You've got to make the decision to continue to hold. And that's one thing where, we have a propensity in investing to see our investments increase, and we want to take the profit, right? So you buy Amazon, which is just hypothetical, it goes up 20%. You say, wow, I just made 20%. I didn't do anything. Take those profits. Maybe I'll buy it again lower. The thing to remember, though, is there's no guarantee it's going lower. And the big wealth, the big gains accrue not by selling after 20, it's holding for long periods of time. It's the compounding. That's how $1 or $100 turns into $1,000. It's slow compounding. But if you don't have the conviction to hold on, you're not going to make it to that endpoint. If you sell when things get rough or after a small gain and you don't go back in, you're not going to compound. And that's probably one of the greatest mistakes people make. They sell their winners way too early. You're much better to be comfortable with the company, continue owning the stock, obviously manage it. If it's worth 50% of your portfolio, maybe bring it down a little. But the key takeaway is if you're going to own stock and own them in size, you need to know these companies. Otherwise, you will not have the fortitude to hold on. And I'll just note, Amazon is a wonderful company, right? It's worth almost $2 trillion. Well, over the last 20 years, I believe there were 4 different instances where Amazon fell by over 50%, including one where it fell 90% in the year 2000. So Jeff Bezos, the CEO, who everyone knows is one of the richest men on earth, he had to sit through all of those periods. And you as an investor, if you're making a big bet on a company, which again, be mindful of risk, you need to know that company.
Awesome. Thank you. The next question, the attendee is wondering, can you talk a little bit about the shift from the traditional ways that companies choose to list, IPO versus SPAC, and why that is?
SPACs. Eric, great question. This is a fascinating part of the market. So really what we're seeing with technology and sort of the increasing digitalization of our world is all parts of our lives are being disrupted. Finance is no exception. So, the traditional way that companies went public, which is issue shares, is they would work with big banks to what we call underwrite an offering, and they sell shares to the public. What that does is the cash goes to the company's treasury. It's used for investing, for growth, et cetera. The problem is it can be very inefficient. So, and it's slow and cumbersome, and it costs a lot to do it. So, we all have seen the IPOs where stock goes up like 50%, 60% when it opens. That actually is a terrible outcome for the company because it means they left a lot of money on the table. They probably should have issued those shares much higher and had more of the benefit of that issuance go to the common shareholders, the founders, the employees. So SPACs and direct listings, which is another form of an IPO, sort of circumvent that. SPACs generally have been a bit of a, not a loved structure. It tends to be very shady. Back in the day, it was used by very, very speculative companies to go public. Lately, it's actually rose to prominence quite a bit. This year was huge. All I'm going to say on those SPACs or SPACs, be very careful. They're what we call a blank check company. So effectively, you give your money to a promoter. They're going to get a massive fee upfront for creating the SPAC. And then the promise is simply that they're going to invest in a company where you're going to get your money back, and they're going to trade on an exchange. The oversight is low. You really need to know what you're buying. And I think most of them are going to end up being a disaster for everyone but the person that promoted it. So just be careful. But I just think it's a natural evolution of digitalization of financial markets. I think it's going to become more of the norm and probably better regulated. But in the early days now, I'd be very, very careful with it. Not say they're all going to be bad, but not everything that is shiny turns out to be gold. And I think SPACs are going to be one of those types of those concepts that probably aren't going to all work out well.
Great. Thank you so much. The next question is how mutual fund investing could be better than directly buying stocks and relying on fund managers.
How much? Okay. So, I think the big there, if I understood it correctly, is what's the advantage of using a mutual fund manager rather than buying stocks directly? And in large part, it's simpler. It is more efficient from a diversification standpoint. But I'm going to be totally forthright in saying, in today's world now, you can buy very, very low cost options, which historically you had to use mutual funds that come with a very high cost. And this to me is a good thing because you do not want to pay more for your investment products. That will only erode your returns. Generally, paying less is one of the easiest way to instantly enhance your returns without taking any more risk. So I would say, investing in mutual funds or indexes, ETFs are a great diversifier. They will lower the risk of relative to owning one or two stocks. I think they're very efficient. They're great for most people, but be very careful on costs and just make sure you know what you're buying. Not all indexes and not all mutual funds are good. Try to avoid chasing performance. This is a surefire way to hurt your returns. So, you find a fund or an ETF that did really well over the last 5 years, maybe it's first quartile. Well, the odds of it remaining in the first quartile are 25%. So I tell people all the time, just be mindful of that when you're going in investing. Don't use its performance as the guide for what you're going to expect in the future, because it doesn't always work out that way.
Great, thank you. The next question I believe is coming from a student. They're interested in potentially switching into finance as a career. Do you recommend any resources to find out if this is right for them?
Yeah, I started off with the learning element, right? That's the best way. I'll tell you, I did not come from a finance background. I studied political science and political economy, economics. And I stumbled into this actually. I started working as an assistant for a finance firm, an investment firm, and I found I loved it. I'm extraordinarily passionate about it. I have a ton of curiosity. I can just devour information. I knew it was for me. So I would start by education. Read some books. Does it interest you? Do you feel like doing it on your own accord without any sort of motivation of monetary, prosperity, anything like that? That probably is the best way to start thinking about it. And, take a couple of courses, just make sure you like it, because doing it just for the allure of making money or making more money doesn't work out very well. You need to be curious. You need to be passionate about it. And I would allow that to drive the decision, whether finance is right for you, but expose yourself to it. Read some books, watch some things on YouTube, take a couple of classes, and just ask yourself, do you feel passionate? And if you do, roll with it.
Great, thank you. The next question, the attendee is wondering, what is margin investing?
Yeah, it's investing with debt. So this is, all it is you're being lent money you don't have. It's based usually on the value of your account, and effectively you get to magnify the upside and the downside. So you are taking money and you're borrowing it and investing it. It can be wonderful when things are going well, and it can ruin you when things are going down. And in many ways, I just tell people, if you're using margin, be very, very careful. Compounding, which is that beautiful concept that takes my $100 and turns it into 1,000, it has a dark side. It's volatility. So I go back to the commentary on, 80% return and 90% return or loss, what are the differences? Well, with compounding, if you gain 100% on the way up, but you lose 50% on the way down, it's asymmetric, right? But because of compounding, that downward movement wipes out all of your gains. So you just think with leverage, if you have $1, you're investing 2 and you lose 50%, you're wiped out. You've lost everything. So it's just investing with with debt or with lent money. It's riskier, and you have to be very mindful of that.
Great, thank you. Our next attendee, as an international student, is wondering if the ways to start investing are the same as an international versus domestic.
Yeah, I would say it is. Absolutely. I mean, what you're going to be focused on might be a little different depending on where you live in the world, the background, the context, etc. But I want to say that the concepts we talked about today are universal. How to think as an investor, how to make decisions. And I think in many ways, the language of finance is very math oriented, and that cuts across geographic borders, languages, etc. So conceptually, the things we talk about, it'll be the same whether you live in Canada or outside of North America. Some of the details will vary a little bit, but generally what you're learning and sort of the foundational ideas, they will remain the same.
Thank you. The next question is wondering about diversification, investing in the same industry but different strategy. And the example they gave was Tesla, which is a hydro car, and Toyota, which is diesel.
Yeah, so this is neat. That's what we call sort of a market neutral. This is a sort of strategy that's used by hedge funds, where you'll take two different securities in the same industry, one that you think will do better, one that's worse. You can, in theory, buy the one you think will do better. You could, in theory, short the one you do worse, or you can invest a little bit of both, let's say. And what you're trying to do really is hedge the bet, right? You're trying to offset one with the other. It makes sense in theory. In practice, it can work, but I'm going to go ahead and say, just choose the one that you like better. But it goes back to really strategically understanding how you make a portfolio. How big is the position in Tesla? If it's 1% of your portfolio or less, well, I don't think you really need to worry a lot about diversifying into Toyota as well. I think that becomes an idiosyncratic bet on Tesla. In terms of my recommendation on diversification, it's more go broad. I go back to it. Most stocks will lose money over long periods of time, and taking a step further, are going to underperform the markets as a whole. So every time you're buying a stock, know that likely you're hurting your long-term returns relative to buying an index. Not always, but if you look at pure odds, that sort of tilts in the favor of using an index. So I would say most of your portfolio should be highly diversified, a core basket of ETFs or index funds. And then outside of that, you can, explore. You can add a couple of companies here and there, obviously not too big, but to me, that's how I would approach diversification. Buying, 4 different stocks in one sector, you still own all automakers. And if it's not a good time for automakers, your portfolio will get hurt, and vice versa. That to me is not really diversification. I would much rather you own different sectors, different types of industry across different geographic areas. That I think is better diversification. And I see someone asks about investing in bonds. I think Eric does, or Eric did there. That's another level of diversification. What that's doing is you're now taking assets that aren't really correlated. They don't move all the same. Because if you own just a bunch of stocks, they're more or less going to be influenced by what markets as a whole are doing. During March, when everything was falling precipitously, well, some stocks fell more and some less, but generally all stocks fell. That's high correlation. On the other side in a portfolio, you might want something that doesn't. So cash could be one. Bonds, which are, I would say, the opposite of stocks. A bond is simply you're lending money to a company or a government. You're going to get a fixed interest rate and you get your money back with some degree of or some expectation of that occurring, depending on the risk of the company. So bonds tend to move inversely to stocks. Stocks go up, bonds tend to go down or not do very much. When stocks fall dramatically, bonds go up in value, all things being equal. And that uncorrelated element is what creates more resiliency in your portfolio. And that's why people want to own bonds, because let me tell you, it's easy to see that a portfolio can fall by 40% or 50%. Living through it is really, really hard and stressful, and it's not fun at all. And in fact, there are periods of time, like from 2000 to 2003, you were down 40%, but it happened over like 3 years. Can you imagine, your $10,000 being worth $6,000 over 3 years? I mean, it feels hopeless. And that's why it's a good idea often to think beyond stocks and build more resilient portfolios. And that can include a lot of different things. For some people, it's having private businesses, art, crypto assets. I mean, it can be anything. But the idea there is not everything moves according to the same tune. They're not correlated. And for that, it makes for better portfolios generally.
Awesome. Thank you so much. Being mindful of the time, I'm going to ask one more question today. And this attendee is wondering, is there a minimum amount of money that you have to invest? And does this vary over different types of investments?
It can. I would say generally speaking, in terms of the investors that would be doing it on their own, let's say with Wealthsimple or direct investing accounts, the minimums are very low. You do pay transaction costs for some of these companies, so commissions to buy or sell. Some you don't. But generally speaking, there aren't really minimums you need to be aware of. Some funds, mutual funds, or some very exotic type of strategies will have minimums that can go up from $1,000 to $50,000. But for the sake of investing at its simplest form, no, there's not really a minimum you need. It's just get started. You can go buy $100 worth of a fund or an index and just slowly every month add another $100 to it. And it's going to work out really well for you. You don't need to worry about that. And generally, if you're looking at things that require you to invest, big sums, be mindful of that. There's probably a reason there. There might be a risk there, and you have to ask yourself, is that really for me? Is that something that will benefit me? And the answer will probably be no.
Great. Thank you so much, Ivan. Unfortunately, that's all the time we have for questions. I just want to extend the biggest thank you for joining us today and for teaching our attendees. Are there any final words you'd like to leave with them before we close out?
Yeah, and I see there's a few more questions, but I just, we're in a market where things have gone very well for investors, especially since the disaster of the spring. Note, it won't always be like this. The long-term returns are 7 to maybe 10, 8 to 10. So getting 30%, 40%, or 200% returns in a year is not normal. Doesn't mean it crashes on the way, but it does mean you got to adjust your expectations. So be very mindful of risk. Again, not everything that shines turns into gold. And note that no one's your friend in the markets. No one owes you anything. Even when you're reading on Reddit or on YouTube or on Twitter, be mindful of who's giving you the information, vet it, do your due diligence. No one is out there selling you $10 stock tips because they've made $10 billion. I'm going to promise you that. If they had a secret sauce to it, they're not giving it away for free. So just forget all of that. Focus on learning more, becoming more aware of, what it means to invest, who you are as an investor. Be patient, save as much as you can, and good things will happen.
Great. Thank you so much, Ivan. Again, we really appreciate you joining us today. Today's event was recorded, and the recording will be available in the coming days on the AC Hub On Demand website. A link will be shared in the chat now. This is a great way to check out recordings from all our past virtual events. And the AC Hub does host a variety of virtual events every month. So for more information, you can visit the Student Sports Services event calendar and follow us on Instagram and Twitter. So those links will be shared in the chat now. So thank you again, everyone. We look forward to seeing you online for our next virtual event.